Every software company owner should be looking at their company and asking, would someone ever want to invest in us or buy us? If you don't, then you run the risk of losing the ability to ever meet the true potential of your business. And you may never be able to sell your business or attract the investors you need. Hi, everyone. My name is Andrew Parrish. I am the managing partner of a company called Alternate Solutions Consulting, and we work with small to mid-sized businesses and pre-revenue businesses on tax and financial strategies ranging from fractional CFO and bookkeeping to capital advisory. Today, I want to go over some of the common themes we see in software companies in particular that prevent them from maximizing their true value. So let's start with what are the common goals of most owners of a business and a software company in particular. One, to maximize the value of the company and then sell it. Two, attract investment from private equity or venture capital to achieve their growth goals. And three, build a valuable company that builds wealth for the owner and creates positive change in society through its product and people. And even if you are solely focused on number three, which would be the hold the company strategy, it's helpful to think like an investor or buyer to increase the intrinsic value of your business. So, what are investors looking for? A company that has underlying value that can be increased through certain strategies and create a good return for the investor. To take a look at how you could increase the value of your business, it might be helpful to look at it from the perspective of a private equity investor or PE firm. And what do private equity firms do? They look for companies that have strong cash flow to support the debt they may need to take on to finance a leverage buyout. And two, have some sort of hidden potential that can be exploited to increase the value of the company and then sell it for more money, right? And if you're a private equity firm, you're looking for a company that can produce profits to meet what's called a hurdle rate and internal rate of return, which are all PE terms. And to increase the profitability of a business, a PE firm will develop what's called a value creation plan, or VCP. And I think it would be helpful for the average software company owner and business owner in general to go through a VCP exercise, since even if you are not looking to attract private equity, you might end up increasing your own profitability and the value of your business in the process. Investors coming into a software company look to create value in multiple areas. And we'll just name a few of them, but they want to grow revenue. They want to modernize the product or the technology. They can innovate the product. They can acquire other businesses. They can improve or expand the margins, and they can do some financial restructuring and engineering. But at my company, we primarily focus with the financial points. But you'd be surprised at how getting that area in order, getting that house in order, can affect other areas. So what can a software company do to think like a PE ninja and increase its value through some financial strategy? One, balance sheet management. It is important to have a clean balance sheet and to monitor your debt service against your cash flow. Many times companies fail to tie these two things together, okay? So an example of thinking outside the box with strategy, we have a company in Northern Virginia we work with that has solid cash flow and big cash reserves. Good company. It was servicing debt it had taken on when interest rates were low. They were also leaving a lot of cash in the bank. And we helped implement an arbitrage strategy that took advantage of financial instruments during a high interest rate environment so that the company could earn more money on its cash than it costs to service its debt. All doing this while balancing the cash flow needs to run the operation. And we squeezed a 2% margin out of this strategy. Okay, so thinking like that is helpful. Number two, key performance indicators, or KPIs. A lot of owners we work with, they run the company with an eye on the product and innovation and vision. And this is absolutely needed for a company to be successful. However, financial controls and performance monitoring can often fall by the wayside. And a lot of companies, they cannot answer key questions that they should be able to answer, like what is your customer acquisition cost, your CAC, your CAC? What's your cost per client, your CPC? What is the lifetime value of every client, CLV? What is your EBITDA right now, and how does it compare to other peer firms in your industry? A lot of times companies can answer, they have an easy time answering questions that are associated with the top line, like what's our monthly recurring revenue or our year over year growth. But these other KPIs that I just talked about, they often require a higher level of accounting controls. And the big firms hire CFOs and teams of accountants to keep track of these KPIs. But the good news is they are relatively easy metrics to establish and track with the right system. And that's what my company does. We help clients establish these systems. Understanding these KPIs is key to increasing the value of a company through improved margins, which is a strategy we mentioned. Number 3, budgeting and forecasting. So obviously growing revenue and margins at the same time is the ultimate goal, right? But in order to meet these goals, a value creation plan relies on benchmarking. And to do that, you need to establish budgets and forecasts. You'd be surprised how good a forecasting exercise can be at setting and achieving revenue and profit objectives. But many companies don't know where to start, especially when it comes to forecasting the bottom line, which again is why people like us exist. So 4, cash flow is king. If you are ever going to look attractive to an investor or financier, your business has to be thinking about improving and having good cash flow. Cash flow is the lifeblood of any business, and it is necessary for growth, which you want and an investor wants ultimately. And unfortunately, a company can be profitable but still fail if their cash flow is not properly managed. And what's unfortunate is that many business owners look at money in the bank and equate it to cash flow. So your finance strategy needs to be projecting future inflows and outflows of cash to manage that key metric. So these are just 4 of many winning strategies and moves that companies can make to create value. Obviously, there are layers to making these moves, and that's frankly why people like us exist. And even if you're wanting to hold and grow your company, thinking about your business like an asset that someone would want to invest in will lead to success. And if you are looking to sell your company in the near future, these become even more critical. And we can have a whole separate video about the selling mindset. But for now, again, I'm Andrew Parrish. Thanks for tuning into this video and stay tuned for more.